The Canadian labour market added 1,100 net new jobs last month, which was lower than the roughly expected 20,000. Meanwhile, RBC Economics says the data was broadly in line with estimates. Let's go to Nathan Janzen, Assistant Chief Economist with RBC Economics Research. Thanks for joining us today.
Thanks, my pleasure.
So what's a big disconnect between what was expected and what we actually got?
I think the reality is Canadian labor market data is very volatile, especially the employment count. And so if you're off by 20,000 versus a consensus estimate, obviously that sounds like a very big number, but it's actually relatively small compared to the statistical error that's common month over month in that data. So I think broadly speaking, the data was still consistent with expectations going in. I think we saw tariff uncertainty, trade uncertainty really start to intensify in February, and it's early. For that to really start showing up in say significant amount of cutting of staff that early when you've had tariff uncertainty, but not yet tariffs actually implemented. But what we did expect to see was potentially some signs, that hiring was stalling out, particularly for trade sensitive sectors. I think we saw that, but at the same time, we also saw, the domestically driven side of the economy still looking firmer. So that would be something like trade employment, retail and wholesale trade was quite strong, and consistent with some of the stronger retail and consumer spending numbers that we've seen domestically in recent months. So you're still seeing this push and pull between the negative impact of trade uncertainty on the goods producing side of the economy, but then what we've seen is absent trade risks, what's been a better macroeconomic backdrop in recent months for Canada.
So essentially, there's a paralysis going on, if you will. People aren't sure what to do, so they're not doing anything?
Certainly, there was some evidence of that, on the goods producing side of the economy. Manufacturing jobs did decline outright in February, and some other declines in transportation and warehousing activity, which is often associated with cross-border trade. But if you look at the balance of the economic data, the unemployment rate, for example, held at 6.6%. So still down from where it was at its peak levels last year. Still consistent with the view that we have been seeing the weakness that had been building in Canadian labor markets had been leveling out, and we have actually been seeing some signs of net improvement.
Okay, so
the concern now is really just how long can that be sustained, given trade risks are still significant going forward.
Some have been saying that the weather in February was a big factor. We had some major storms in the eastern part of the country. I'm wondering if you agree with that.
Yeah, absolutely. One of the quirks in this data was there was a very large drop in actual hours worked in February, and it was the largest decline month over month, I think, since 2022. And it does look like that was largely weather related. It just so happened that the survey period for this survey, overlapped with significant winter storms in populous parts of Canada. So that portion of the weakness looks like more tied to weather than a fundamental weakening. That portion of weakness you would expect to bounce back in future months. The worry will be more, in those trade sensitive sectors, whether employment, whether hiring demand can withstand trade uncertainty going forward.
So, Nathan, I'm wondering whether the number that we saw today, or the numbers that we saw today, will affect your outlook on the Bank of Canada announcement next week.
I think from our perspective, it really just highlighted, that it will be actually a tough call for the Bank of Canada next week on whether to cut rates for a seventh consecutive meeting or not. I think if you looked at the backward-looking economic data, it's hard to argue that it hasn't been looking significantly firmer. We had Q4 GDP surprise on the upside in Canada. We've had a couple of upside inflation surprises. And, again, the unemployment rate is still down from its peak levels late last year. So in the Bank of Canada's policy framework, that's consistent with, a smaller output gap, and down the road, less negative pressure on inflation given an improving macro backdrop. So all of that would kind of argue in favor for a pause in rates. But at the same time, we do have a lot of significant trade uncertainty going forward, and the level of interest rates is still, relatively high, with the Bank of Canada rate still, in the top half of what they estimate is the neutral range at 3%. So a very, very close call. Our kind of base case has been, our own base case has been that they'll hold rates in March, given the improving domestic economy, but certainly significant risks that they'll need to cut again, and partly just dependent on the flow of news announcements and rhetoric coming out of the White House, which is. The reality is that's very unpredictable over the next few days.
Which is constant, right? Which is a constant stream and will be changing up to the minute. All right, Nathan, appreciate you taking some time for us. Thank you very much.